All right, good day, everyone. Welcome back to another episode of Spark Your Fire. I'm your host, David Shee, and as always, we've got John Camino here with us. His lovely bright lights now mastering AI, from what I'm hearing now, basically. So it'll be an exciting time ahead of you, John. What's going
Yeah,
on?
moved from the abacus to straight to AI. Skip Google. I'm very good. I'm very good. Happy Friday.
ChatGPT is going to be our good friend very soon, aren't we?
Yes,
Basically.
it's
You know,
coming
I've heard
through.
some scary things about AI that you can actually create your own avatar. Because if you feed enough information about you, one day I might be speaking to John's avatar instead of John,
Mm,
but I won't be knowing that's John's avatar because you will sound exactly the same way as how the actual John is. And you have exactly the same logic because there's enough data about you, right? Let's say, for example, for the
mm,
last 2 years, past 2 or 3 years, we've been doing this consistently, one episode every month, that kind of stuff. If we
yeah,
feed all these data into ChatGPT and ask it to create a John and David avatar, guess what happens?
yeah. You could do it.
You will get a replica with, I would say, probably a resounding 90% similar to what we are
Really.
now. And if you ask it to do an interview, yeah, like I've seen it happening. It started to there's AI virtual interviews and podcasts and all that kind of stuff that's been
Mm.
created, which is scary at the same time. But at the moment, we're not that man's. Both of us are true people.
It already knows our dumb opinions. I mean, I didn't realize that AI could be used for anything useful. I thought it was just for putting my head on like a baby's body or making me look like a baby with my normal
Oh,
voice.
that's that's
So now that
that's
it can be.
that's elementary school, John.
Oh, jeez. Jeez.
That's
All
a
right.
But
It's
yeah,
coming
it's
for us.
scary. But yeah, no, you did mention. I mean, the reason why I mentioned is I think you started to use ChatGPT to help you collating some data. And it's been really good, isn't it?
Correct.
So far.
Correct.
So helps you save you a lot of time, especially when it comes to one of our favorite series talking about these gold to Sydney property ratio, right? It definitely helps speed up, saves you all the time
Yeah.
as well. So. Anyway, without any further ado, I think this is our second installment of 2025, which is going to be the last installment of the property to gold ratio, or
Yeah.
commonly known as is it a good time to buy a property? I think that's how it started
That's
initially.
right. That's right.
So yes, I think we'll jump straight in, John, in terms of what
Let's
we have
do
to
it.
uncover now.
And just to add a footnote, so it's not just gold to Sydney real estate. We will go through each capital city,
Oh,
and
that's
we
right.
will
Yes.
assess which capital cities are overvalued and which capital cities are undervalued.
Hmm.
So let me take you through some slides. And I'm going to share my screen. Just a tick. All right, you
Right,
guys can
coming
see that.
up.
Okay.
Beautiful.
Let's get started. So I mean, this is one of our favorite and most well known data sets. So we're gonna look at the property market to gold. I'll explain why in just a moment. But to kick off, let's look at real estate in more familiar terms, which is nominal prices. So this is the real estate house prices, not overall property prices. These are house prices since 1979 up to the 31st of July 2025. So like this data is like 2 weeks old.
Mm.
And what we can see is, I suppose, a familiar trend of real estate moves higher over time. This is why we bother investing in it, because we're getting these returns. Add some leverage, and it's a thing of beauty. The comment that I always make, so it's two comments I always make, is one is that real estate is an inflation hedge, and that it goes up over time is something that we should accept. It's not always the best performing asset, but just in terms of like uh, general acceptance of a principle that real estate, particularly because it's based on scarce land, appreciates is something that we should accept, and it's something that's true. Observation number two is that once we get to this point here, which is 2008, this is the GFC,
Mm.
little bit of a dip, but then we go on this sort of
Exponential.
20-year wild ride of volatility and crashes, mini crashes and big recoveries. What we can see here is that we're essentially in a period of central bank activism. So whether it's September 11 or whether it's a drought or whether it's a pandemic, the solution was always low interest rates. And low interest rates is a proxy for currency creation. So you're pumping the banking system full of credit.
Mm.
And that's why you're going to get these mini booms and busts. So house prices since 2079. If you actually put a trend line in, it's a um, it's a smooth, gentle appreciation. All right. So that they're nominal house prices since 1979.
Yeah.
However, as we establish and as we know, most of what we believe to be capital growth is really just in a response to inflation. So there's just the amount of credit that's been created in the system pushes prices up. So if I was to put, rather than Sydney house prices up, if I put Sydney bread prices up or Sydney movie ticket prices up since 1979, you would get this shape, broadly speaking, as well. And the reason is because the price of everything is going up. So house prices are going up, sure, but so is everything else. Egg prices, let's say.
Yeah.
So what is Sydney house prices really doing it? Or put another way, how do I know if it's expensive or not? Like it's going up in price, but is it going up in value? How do I know when Sydney house prices are expensive and how do I know when they're cheap? Because in 2008 or 2009, let's say, where's 2009? In this point here, Sydney house prices were at a generational low because after the GFC, Sydney house prices crashed and they were at decade-long lows, but they were still like triple what they were in 1970. So how do you know when it's something is relatively inexpensive? What my preferred method is not real estate divided by the median income or anything like that. It's you want to divide real estate prices by any other price that exists in the economy, other prices that are also affected by inflation. So you could say, what Sydney house prices priced in barrels of oil, or you could say, what are Sydney house prices priced in bushels of wheat, or what are Sydney house prices priced in eggs or whatever. But all of those items are just consumer goods. What you want to price things in is durable goods that have a monetary value or a monetary quality. And what we always do is price real estate or anything really in gold, because while you might be able to print money at 8% a year, you can only mine gold at 1% growth a year. So gold is money. The reason gold appears on the Bloomberg screens is because gold is money. And when we're measuring how valuable or worthless the US dollar is, it is done against gold. Or the reason central banks have gold in their vaults and they don't have diamonds is because gold is money and diamonds are jewelry. All right, that was a very. I need to take a breath,
No, that's a
but
well explained, John. And I think, the reason why we're using gold is because it's finite to a degree. You can't just keep on printing and creating more gold, isn't it? It's limited.
correct, correct,
That's why
correct.
you're thinking to use it as an anchor as opposed to, let's say, for example, bread, which you can always make more bread. So,
Yep,
comparing Sydney house prices to bread probably doesn't make much sense because both will be going at an inflation rate. So they'll
yep,
be fairly similar to like a one to one, whereas you want to anchor it against something that potentially like a gold or silver, or some sort of commodity
yep,
that's
yep,
not that you can easily kind of create as
yep,
such. Yeah, so that's the concept
yep.
behind it.
Yeah, like real money can't dissolve when it's combined with water, so you can't use sugar as money,
Mm.
and so on. And it has to be all these qualities which we don't need to cover here. But gold has historically in all cultures been money. So what if we price real estate in gold rather than, or in ounces rather than in dollars, because we know dollars are losing value through inflation. What asset does not get affected by inflation? And it's gold. And one day we might be able to do Sydney house prices in Bitcoin.
That's
But
true.
Bitcoin is too new for this. You can't do a long data set. So what we notice when you measure real estate or anything else in gold, what you find is actually rather than just this asset going up and up and up in perpetuity, such that one house in Eastwood can eventually buy the world. Um, what you actually see is that everything, including real estate, is stuck in a valuation channel, and it goes from undervalued to overvalued to undervalued to overvalued, and it will do that in perpetuity. So things aren't always going up in value. They're actually just some years are overvalued, other years are undervalued, and they're bouncing within a valuation channel. Now, the valuation channel in terms of real estate is between about 700 ounces, just over 600 ounces, and about 400 ounces. And so it's trapped in that channel over long periods of time. And you know that when real estate gets to 600 ounces, real estate's overvalued and your returns for the next couple of years are going to be low. But when real estate's at about 400 ounces, you're generally speaking, you're at the bottom of a cycle and your returns are probably going to be a bit better. Now, this was true on all of the things that we did and all of the gold to real estate ratio discussions up until about 6 months ago, when real estate broke through this multi-decade floor, this floor that had been established since about
400.
1987 when they deregulated banking. But like 380 ounces was always the bottom of the real estate market since the 80s. And we've just broken through. Now, everyone would have seen that gold's had a good run. Gold's back in the news. People talk about gold. That's a good thing. Gold is money. But a rising gold price also implies certain things. And what it's implying is that we are in the midst of a silent correction in all the other assets. As people flock to gold, they're sort of pulling their money out of other things. And this is what you call a silent crash in real estate. The same thing's happening to the Dow Jones, the S&P 500. There's a silent crash that's been taking place really since the beginning of the century when things were overvalued. You had the dot-com bubble, you had a real estate bubble across the world in the early noughties, and gold has been revaluing these assets lower. So what does it kind of mean for us though? So at the moment, gold is at 299 ounces. The last time we were at 299 ounces was in 1988. So there's been a big correction. Can you see me move the thing around?
Yes. Yep.
All right.
The mouse, very slowly, but yeah, if you move the mouse,
And the question becomes, like, if we accept that real estate is currently inexpensive or cheap, at least priced in gold, or at least priced in inflation, what's next? And the answer is I don't really know, but I also know that there's really no resistance between this level and the 200 ounces. So I feel like gold is probably going to outperform real estate for probably another year or two. And then we're at the rock bottom. I can't imagine it going below 200 ounces. There's been a bit of a bounce. We might be at the bottom here, but I still feel like it's got to blow off a little bit more economic energy from this overvaluation back up here in 2004. So I think that this ratio goes lower. But if I draw us back to the previous slide, where we're actually getting a bit of a kick, real estate in Sydney house prices do have a kind of new lease of life at the moment. And so I can see us really booming over the next couple of years because in real terms, it's quite inexpensive. And you can sort of see the property market starting to take off again from a new much lower base. All right, I'm going to take a breath. David Shear, back to you in the studio. Any kind of thoughts, observations?
That is interesting, I gotta say. Like I think as you rightly pointed out, like, the last time was this lows was 1988. And
Yeah.
they've been following this trend and bouncing in between the 380 to about the 700 ratios. But yeah, it's gold's been going up a lot, I think,
Yeah.
just because it's one of those reserve commodity that people flock to when there's a lot of uncertainty, and we know what Trump's been currently doing with trade wars and everything, right? So a lot of people
Yeah,
would
it's
have
all that stuff.
chosen to basically stock up gold in these uncertain times, as such. So could it be that because of that reason, that's why it's not because of Sydney house prices is not growing as fast, but it's just because there's a lot more demand for gold at the moment, which is
Yeah.
causing that to accelerate more towards the 200. as opposed to the other way around.
Yes, it could be that. I mean, and to add to the gold is overvalued thesis, we've got wars in Ukraine, wars in the Middle East, we've got
Mm.
trade wars with tariffs and so on. Um, One of the interesting, I'm personally of the view that gold is currently undervalued, and this is not financial advice because you could definitely make an equally strong case that gold is overvalued, and this chart might be one of the, part of that case. But the thing is, if you look at the gold ratio to the money supply, the gold ratio to the M2,
M2. Yep.
um, gold is particularly after all the currency that was created after COVID, gold is at like a multi-century low. Or certainly that might be a bit of certainly a low since the late 1970s, since this chart began.
Mm.
Um, so they've created a lot more currency, a lot more credit than are in the gold vaults under the central banks that create that credit. So I
Yep.
feel like gold is at a low, real estate's at a low, but gold feels a lot more undervalued than real estate is undervalued. So I would say gold is. Still think
Catching
gold.
up. Is it?
Gold's doing a multi-decade catch-up at the
Yeah,
moment.
he's doing a multi-decade catch-up
Yep.
basically.
Yep.
Whereas, if you compare it to the velocity of the growth on Sydney house prices, it's fairly stagnant for the last 2 years or so because of the fact that,
Yep.
interest rates been curbing the growth,
Yep.
as such.
Yep.
So, yeah, okay. Well, that
Yeah.
that that explains it. Basically, even just yeah, not from a nominal term, but from a value term. So. In other
Yes.
words, the summary at the moment is Sydney house prices in comparison to gold is definitely not expensive. It's actually a great time
Yes.
to be looking at picking
Yes.
up if you're talking about the true value in comparison to gold.
Agreed. I think that if you're buying real estate in Sydney at the moment, you are nowhere near market highs in
Mm.
real terms. I think you're buying at exceptionally good levels, and I know how crazy that sounds. I can hear it.
Yeah,
All right.
we like to be controversial there,
We
John.
like crazy. Yeah. All right. It does. I mean, it sounds crazy, but when you put this chart up, and it makes a lot of sense. And let's face it, your Happy Meals are getting more expensive more quickly than your house is, but no one cares about Happy Meals, I guess, is um, the other side of that
Big
coin.
Mac, the Big Macs with this, or should call the small Macs meals has been
Yeah.
up since then, basically.
Shrinkflation. I'm sure Big Mac's got smaller and they kept it at the same price.
Yeah, I thought it was
Um,
me growing up, but yeah, shrinkflation is truly there.
It is, it is. So what does this mean for the other capital cities? So let's go through, let's go around the grounds, let's go to all the capital cities, and we're going to ask what is what is the ratio of Sydney to the other capital, which also again prices don't go up in perpetuity; they just go up and down in a
Yep.
ratio to the other things. So we're going to look at Sydney compared to the other capital cities, and we're going to start with the overvalued capitals, and we're going to finish with the undervalued capitals. Um, so let's get into it. So starting with the overvalued capitals, moving to the undervalued capitals. So at the moment, Brisbane would appear to be uh, overvalued compared to Sydney,
Yes.
but not a lot overvalued, just a little bit. I mean, it's still like in the middle of the range broadly, but it's certainly closer to Brisbane being overvalued. Um, this seems to be a worm turning, but it's entirely possible that
Yeah.
there's a slight interruption and then this trend resumes and it gets to these where it seems to bottom out at about 125% of the price of a Sydney house, which is when the
Sydney.
Brisbane bull market's over. And look, maybe when, 2030, the Olympics, it reached, 2030, Brisbane reaches um, maximum overvaluation, and then the cycle that began in 2015 is over.
Mm.
Um, but right now, it looks like Brisbane is still overvalued.
Yeah. Yeah. Yeah, it's very interesting in the sense that it seems to still be going towards the Brisbane overvalued side. Um, Apart from the Olympics, do you think there's anything else that could have impacted or that's causing it to continue to continue to go move towards the Brisbane overvalued aspects?
You know Brisbane a lot better than I do, so I don't know
Mm.
Brisbane that well. I think
Net migration, because I know
net
there's still a lot of people
migration,
that's still moving towards Queensland for lifestyle purposes,
correct,
kind of stuff. And
correct.
there's a lot of job and employment opportunities there as well. When you don't need to tolerate Sydney house prices. From a
Yeah.
nominal dollar value term, you can get for $1 million or $1.5 million,
Mm,
you can get something so much more. So potentially that's one of the things. There's still a lot more demand because of the nominal prices,
yeah.
affordability in Brisbane as opposed to Sydney, which is causing Brisbane to still continue to go strong, or
Yeah.
relatively strong, relatively. Mhm.
One interesting thing about Brisbane is it broke through and it blasted through the $1 million
Yeah.
median house price level for the first time in February this year, February,
Mhm.
March this year.
Yes.
So the median house price in Brisbane is now over $1 million, and it's going up at about 10% a month, $10,000 a month if you're a Brisbane property owner. So it's definitely going up quite quickly. I remember when Sydney, people used to say it cost $1 million to buy a house in Sydney, and now Sydney's at about 1.6 million. Um,
Mm. Mm.
so
Didn't feel that long ago, right? Like, you
no,
think about those cities or those suburbs that make it into the $1 million club.
yeah,
Now it's pretty much every suburb is a multi-million dollar
yeah,
club.
correct, correct. Yeah, yeah, that's right. So Brisbane. So to conclude, Brisbane still on the overvalued side, um, but probably with momentum and its sales, there's probably enough momentum to get it to go to more extreme levels of overvaluation. We're not seeing that at the moment, though.
But there's still, so basically what you're saying there is, um, again, this is just what we think. It's certainly not a
Yeah.
prediction as such. Brisbane will continue to outperform Sydney in the next, let's say, 12 months or 24 months whatsoever, until that graph hits the Brisbane overvalued down to about 125%.
Mm,
Then it will slowly recover, just like from 2009 onwards,
yes.
essentially. Yeah.
The only potential objection to that theory, and we won't know until next year, is that every capital city, except I think maybe Darwin, is showing this little kick up towards
Mm.
Sydney. So
Very
in the
true.
very recent data, Sydney has been outperforming the other capitals, which means that it's entirely possible that the correction that Sydney was experiencing, where Sydney underperformed everyone,
Yeah.
that might be over, and we're back to Sydney in the hot seat. We'll see.
I think a
I
lot of
tend to
it
think
comes
that,
down to interest rates, because
yeah,
like at the moment, everyone's predicting that we are continuing to see interest rates going down, and
yeah,
Sydney and Melbourne are the two biggest cities with the biggest mortgages, and therefore more sensitive to those. So, the
correct.
lower the interest rate goes, the faster Sydney and Melbourne is going to run.
Yeah, that's right. Yep, that's right. Adelaide is another overvalued capital or relatively overvalued capital. I mean, this seems a lot more compelling. We were sort of flipping a coin between Brisbane and Adelaide, which one was more overvalued. Maybe Adelaide is slightly more overvalued than Brisbane, but certainly, I think the Adelaide story is over. I mean, you could see a situation where it reaches kind of the levels of overvaluation that existed in Adelaide back in 2009. But I kind of feel like I don't, and it's possible, and I don't know if they've solved the shortages that exist in Adelaide. But I feel like that looks like a bottoming. I feel like the Adelaide thing is over, and that the capital is going to be returning to Sydney. But I could be wrong. It could be wrong.
Yeah, yeah, I think looking at the charts, it seems to be going that way as
Yeah.
well, and as I tend to agree with you. Um, Adelaide has a really had a really good run
Yeah.
for the last couple of years, especially just looking at the graph. Look at how much of a deep dive that's that it went from
Yeah.
2021 right to where we are now. Pretty much swaying that quickly in line with pretty much Perth. I think Perth had a really strong run
Yes.
after Adelaide as well in a short period of time of 2 years, right? So Adelaide
Mm,
started that, and yeah. So now I think it's at the tail end of that growth cycle. As Sydney starts to
mm,
pick up momentum, I think Adelaide will start to slow,
yep.
and the graph will trend towards the
Yep.
medium straight
Yes.
line.
Yes. 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 I think Adelaide benefited as well from kind of a repatriation that we saw during COVID. Like people
Mm,
would move back to their home cities, they'd move back with their families, they'd work for, and I kind of feel like that's over as well.
mm.
Uh, that said, genuine shortages in Adelaide, and you see that in the rental vacancy rates.
That's still an issue across the board.
Yeah. Perth. Oh, Perth feels probably in balance,
Mm.
maybe not overvalued, but we're working our way to undervalued capitals. And I don't think Perth is undervalued anymore. So, what to say about Perth? It had a wonderful run from about 2022 onwards. Um, this looks like it's over,
Yeah.
but I can't imagine that there's no more gas in the tank in Perth. So I feel like this is just a deep breath before it keeps going. And I think that even if Sydney outperforms Perth this year, I suspect momentum will swing back to Perth
Yeah.
for the few years after that. Very interesting to call it because it looks like it's in such balance at the moment.
Yeah, it's a balanced market, isn't it? Like, it's
Yeah,
this is probably the city that's closest to the median trend line than any other
mm,
cities and that we've
true.
seen. But yeah, look, I tend to agree with you. I think, with Perth also being a massive shortage in terms of supply, that line is still going to continue to move more towards a Perth overvalued side of things. So it is continuing to
Yeah,
grow, but again, just depending on how quickly Sydney bounces
yeah.
back or how quickly Sydney goes too. So
I think the question with Perth is, it was this 2022 to 2028 bull market that, I mean, because I remember briefly at the
2008.
time,
Mm.
Perth nominal prices exceeded Sydney. So Perth was more
Yes.
expensive than Sydney. And the question is, does that happen every couple of decades as part of a cycle, or was this like a once in a generational bull market in Perth that we're not going to see again? That this is the outlier, but if you take this out, we're just bouncing around the 200% mark
Yeah.
and don't expect this to repeat. I don't know. I still feel like I don't know. I
What
think
was
that
back in
there's
2002?
um
The
well,
mining
there's a
boom? No, the
commodity
mining
boom,
boom. There was the
mining
mining
boom,
boom. Yeah, okay, yeah.
but the mining boom coincided with an Aussie dollar boom as well. So there was
Okay.
a very strong Australian dollar that was essentially at parity with the US dollar.
Yep.
And what happened, I think, in the intervening terms was there was a 20-year bear market in the Aussie dollar and in commodities at the same time.
Mm.
So not only would commodity prices need to go up, for Perth to become overvalued, the Aussie dollar, I think, would need to get stronger at the same time. And I
I
think
think
that
it's
that would,
weakening at the moment from memory.
it's weakening, but I don't know how it gets weaker than where it is at the moment.
Yeah, okay.
But yeah, not a currency
So
guy.
you need to have those both conditions to tick in order to see that Perth super boom.
I think so. Yeah, because this was an AUD boom as well, which I
Yep.
think is always lost in the conversation. Yeah,
Yeah.
to have the Perth boom.
Okay. So commodity plus Australian dollar boom, that's when it will like to see that miracle happen,
Yeah,
swinging
yeah.
massively from a 200% to literally 100%. So
Mm,
that's huge. But yeah, I think it's unlikely we see that phenomenon
mm,
happening at the current rate, isn't it? So
yeah, yeah. But I think the odds are, even though it looks like it's turning around and moving into Sydney's favour, I think there's a bit more
there's
uh,
still more gas in the tank. I
more
think
gas in the
will
tanks.
still continue to perform, just not as crazy as what we've seen in the last 2 years, or
Yeah,
become more of a slow and steady. In fact, I think that's probably going to be the narrative for the next couple of
yeah,
years. Be more of a slow and steady
yeah, yeah.
market. Back to that.
Okay. Hobart, Hobart. So now we're getting into the cheap territory because we're kind of above this line of best fit. We're kind of in the Sydney, on the Sydney side of things. Although I mean, it's hard to know if in. It still feels like it's in a reasonably balanced
Mm.
position. But Hobart seems to be. I would say that we're part of a broader underperformance, and that Sydney is going to continue to outperform
Outperform.
Hobart.
Yeah.
I think the money's been made in Hobart. And I wouldn't be investing there for another year or three.
Yeah.
Uh,
Probably not in a short period of time. But I think traditionally Hobart kind of follows Melbourne
okay.
to a degree as well. So when Melbourne had its boom, Hobart generally
Mm,
wouldn't be too far away as well in terms of following. And I think, Hobart's had a really good run back in about, 2017 to about 2020.
yeah,
that's airing more
yeah.
towards the overvalued period. So it's been about 5 years since it's been going pretty stagnant. So
Mm,
give it another year or two. Once Melbourne had its run, I think it's quite normal for people to then start looking at Hobart again being
yep,
potentially the next one to dash. So,
yep, yep.
but
And
it's early
Hobart,
days. Early
place,
days.
I don't know enough about it to know what the driver would be. I mean,
Right.
so it's likely to wash over me a little bit. Uh, so when there's a housing shortage, I wouldn't see it as well as I'd see some of the other capitals. So Hobart, like Canberra, maybe like Adelaide, is a market where and Darwin especially, is a market where you can. It's not as efficient as the other markets because it's not as liquid, it's not as big, it's not as visible. It's where
Yeah.
you can make more money. I just don't think right now is the time for Hobart.
Yeah, look, I think the only reason that will have that next kick again is when everywhere else is becoming very expensive and there's no value, then
Yeah,
Hobart traditionally maybe on a 600 to $700,000, all of a sudden will become very affordable.
yeah.
And that's where the investors will start to get in again or look at it again. Similar story to like Darwin now, right? Basically. So,
Yeah.
Darwin was cheap, like literally $400,000. And, where can you get a house for $400,000 in the
Mm,
capital city? Nowhere else except for Darwin. Well, that's where the investors are going into, basically. Similar
yeah.
story. So, in a few years' time, when Melbourne had its run, Hobart will look cheap. And then they
Yep.
go, okay, well,
That's
it's
right.
time to look at it.
And so on. All right. Canberra. So we're getting closer to the undervalued capitals. I think Canberra's suddenly a bit on the cheap side. That said, I feel like um it's not going to have its turning point moment. So I think it's still getting cheaper and cheaper. But this is where we can start to say I think there's some value investing into Canberra.
Yes.
Um, and there's very little risk of overpaying in the Canberra market. Um, yeah, there's been a correction, I think, since about 2022, 2021, where it peaked out, and Sydney's been outperforming for the last 3 to 4 years.
Right.
And I just think it's going to continue in Sydney's favour for a few more years.
Yeah, Sydney's going to have much more growth in the next few years in comparison to Canberra, I think.
Yep.
Before the cycle, again, similar story, I think, before the cycle goes again to say, okay, Canberra's becoming very affordable now. Let's
Yep.
look at it and that kind of stuff. So, yeah. So, mm.
Yeah, what to say
But
about Canberra? Yeah.
don't forget, Canberra is also full of people who are of government contractors who's gone big wages. So,
Yes.
those are the ones that's got money available. So
Correct.
you never know. I reckon they are going to be quite uh they will also be quite sensitive in terms of interest rate movements as such. Obviously not as big as Sydney and Melbourne, but
Mm.
when those public servants have got a bit of money in cash or in a pocket, they will be looking at potentially how they can further improve their life. So, you know,
Yeah.
maybe upsizing, or maybe looking at investing. But yeah, I think
Yeah.
interesting trying to see how Canberra pans out in the next few years.
Yes. Yes. All right. All right. The last two, and you can guess the last two, which are undervalued capitals, are Melbourne and Darwin. Not to do a great reveal too early,
You already
but
did the reveal, John.
I know, I know. Well, a process of elimination. There are only six capitals, uh,
That's right.
but um, uh, but Melbourne's looking very cheap, and Melbourne, which looked to be staging a bit of a recovery, seems to have petered out. And you even see it in the daily and the monthly data. It's sort of starting to underperform again when it was actually outperforming.
Mm,
Kind of in the first or second quarter of the year.
yeah.
But Melbourne's cheap. Melbourne's cheap. It's up at this 160%, which tends to mark the end or the beginning of a cycle, give or take like a year, give or take some percentages. So I think that the Melbourne, I mean, maybe it gets a little bit cheaper, but we're basically done in Melbourne. Melbourne's ready to fly.
It's at the other extreme now,
Yeah.
basically, isn't it? Melbourne's very undervalued
Yeah.
from this graph. What's going to take to get it to turn? Don't know.
Probably an
There's
election, a state
well,
election.
yeah. I mean, but yes and no. But like depending on whether the other if the other party gets elected, where
Yeah.
and how much changes they're willing to make, right? There's a lot of political headwinds in terms of against landlords and property investors at the moment for Melbourne. So yeah. When's the state election? I think it was next year.
Such a good question. I don't know.
Yeah, I think it might be next year, as a matter of fact. So, if there's a new breath of fresh air comes in, we
Yeah.
might see that turn around. But otherwise, I think there's just going to be more and more compliance that's coming in. I think
Yeah.
recently, yeah, we just released the episode chatting to Andrew Newen from Aurora
Oh, yes.
Estate Property. Yeah, so he was totally across the property management challenges and for landlord that's in Victoria.
Mm.
There's going to be more headwinds that's coming that
Yeah.
way. So I think investors getting into Melbourne need to be mindful that
Mm.
this cash flow dent, including land taxes and compliance, etc., is not going to go away in a short period of time. So you need to,
Right.
while Melbourne market is looking very promising, based on this graph, but if you can't hold on to the property, then there's no reason to look into it. Okay, so
Yeah.
just do your numbers very conservatively. But yes, I think Melbourne will shine. It's just a matter of time,
Yep.
but we don't know when, and there's no immediate indicators to say that it's going to turn.
Correct. And this is hyper macro. Like this is ratio of one city to another city does eliminate a lot of detail and nuance that you would need if you're
Suburb.
actually investing. If you're actually deploying $1 million to a property, you'd want to know more than just the Sydney to Melbourne ratios. This is
Yeah.
hyper macro. One thing to say, that guest is fantastic. I love his content when he's chatting to you. I think it's very, very usable. So very, very
Yeah.
interesting.
Andrew's a lovely guy, right?
Yeah.
So yeah, very helpful. Okay.
Darwin. So Darwin takes the. I mean, so Darwin, the
Man.
worm has turned on Darwin, so it's already reached and bounced off
Mhm.
its hyper undervaluation. But I remember when we did this 6 months ago, we said this is Perth 2 years ago,
Correct.
and now we would say this is Perth 18 months ago, or 2 years ago, I suppose, or 2.5 years ago. So cheap, and it's going up at I think about 3% a month. So it's really on. It's really cooking over there. It's really doing great. Um, I would also say that these Sydney to Darwin in this case, these ratios, they're a little bit lagging. So I remember saying to someone, "Oh, I think Darwin is the most undervalued capital," and he's like, "Mate, it's been like that for 3 months. You can't buy a property there. It's so hot." So there's always a tiny lag in here that
Yes, correct.
that this doesn't pick up. So if it's appearing to be hot based on this hyper macro chart, on the ground it would be
It's already, yeah.
very hot, and it would yeah the horse would have bolted. But that said, if you're buying here, you're still buying at multi-decade lows in the Darwin market. So not knowing anything in particular and only knowing the ratio, I feel confident to say you'd be able to buy in Darwin with confidence that you're not buying in an overvalued market.
That's right. There's a lot of value in there. I think, it's still in the rising market. As you said, right now on the ground, it is extremely hot and competitive.
Mm,
Part of it challenges there's not a lot of stock available. And, Darwin's a tiny city. I think it's even smaller than Townsville, right? So
is that right?
100, 200 Eastern Seaboard investors is enough to be
Mm,
able to change that narrative completely in Darwin. Whilst it's looking promising, but again, we always got to have to caution investors to be careful because it is a volatile market. It goes up very quickly. It could also stagnate very, very quickly as well, because it's such a small market. Very different to Sydney, right? Sydney, it takes a lot of effort to move,
right.
whereas Darwin, like I said, you don't need a lot of people wanting to look at
Mm,
number of properties in order to make it move. So.
correct.
Um, yeah, so I think that's why it's a lot more speculative market than
Yes.
anywhere else. So gotta be careful for those people who's looking into Darwin. I reckon it already had ran for about 12 months, realistically,
Mm,
because this graph kind of indicates about 6 months.
yeah,
On the ground, it probably started about a year ago
yeah,
ish. It's still going strong at the moment, but how much more it's going to go and when's the music going to stop,
yeah.
we don't know. So
Exactly. But I think at the least you can expect it to get to the dotted line over the next year or two, which means
generally speaking, yeah, it should.
you generally outperform the other capitals for a little while. The question, of course, with these sorts of things is how nimble do you want to be with your capital? Like, do
Mm,
you want to be buying and selling? And if the answer is yes, Darwin's a good bet, probably
correct.
better than most parts of
Yep.
Sydney. But if you're not, if temperamentally you don't want to buy and sell, and with all the capital gains taxes that go along with that, then you need to ask yourself, do you want to own a property in Darwin for the next 20 or 30 years? And I don't know the answer to that, but you have to consider how agile and nimble you want to
Yes.
be as an investor as to whether or not this is the sort of strategy for you.
And how easy is to liquidate as
Correct.
well, to sell, right? Because if you miss that timing to sell, guarantee it'll be a lot harder to sell in Darwin as opposed to Melbourne, if you
Yeah.
can get the right,
Right.
so,
Right.
because
Do
yeah,
you, do you have,
most
do you have
investors.
any clients buying in Darwin or?
Very few, because I guess they're more speculative in nature, in a sense. But having said that, I think it's Darwin's great because of the cash flow. So you kind of piggyback with like a Melbourne type of property. So you
Mm,
got the capital growth type of play for Melbourne, and then piggyback that with a Darwin cash flow property. And you get chances are you will get both cash flow and capital growth in Darwin as well.
yep.
Potentially in a few years' time, then if you look at getting out of that market, you just got to time it really well to be able to get out
Mm,
on the right time. Probably before the way it peaks is the way to go. But then again, you can never time when's the lowest and when's the bottom and when's the peak, right?
yeah.
Like just like share markets, you can't do that. So, but
And
yeah,
for our listeners, that what you just described is a strategy called pairing. What it is buying two properties at more or less the same time, or at least forming a portfolio of properties that are quality properties but have opposite attributes. So in your example, it'd be a low yield, high growth property in Melbourne, and to balance that out, you need yield. So you'd buy what is the opposite, which is a historically high yield, potentially lower growth property in Darwin. And as a portfolio, then it starts to really deliver both on growth and cash flow. So
mm,
pairing.
yeah, that's right. No, thanks for explaining that. Yeah, definitely. Darwin's definitely has this place. I think you can't get any other capital cities that's probably more towards 5% yield. It used to be six
Yeah.
percent, but now it's because of yield compression. That's now close, I reckon, maybe 5%. And that's if you can actually get the property because a lot of competition's on the ground right now
Mm,
for that. Mm.
yeah.
So
Awesome. I think that's it. I'm
cool.
going to stop sharing my screen now. We can
No,
have
that's a great summary, John. I think again, appreciate it. I think if we do a bit of round off, Darwin and Melbourne are obviously still the main capitals at the moment that which corresponds to what people are looking at right now, as well.
yep.
Like most of the property investors are primarily looking at those, especially Melbourne, um, or Victoria Melbourne markets as well as Darwin markets. One thing that I guess this graph doesn't show us is like metropolitan and regional areas or metro areas versus
Correct.
regional areas, right? Because they will be growing at different speeds as well. But I guess you're just comparing it to the capital cities. If you've got enough data, and you can always ask ChatGPT for more data, you can also do that same comparison for
Yeah.
like a Sydney to Geelong, Sydney to Ballarat, Sydney to Bendigo,
Mm,
or Sydney to Newcastle, Sydney to Wollongong, that type of comparison as well, right? So that'll spit out that type of data for you as well. But
correct.
yeah,
Yes, and so you're right. Melbourne and Darwin are cheap. They're the cheapest capitals, and the most expensive would probably be Brisbane and Adelaide, and the remaining capitals somewhere in the middle.
yeah,
But I think the other thing, and to go back to the gold chart, is that overall property doesn't seem to be in a very expensive spot. So
mm,
while Brisbane might be relatively more expensive than Sydney right now, I think that the overall real estate asset in Australia, partly because of a deeply undervalued Australian dollar, um, seems really cheap at the moment. So I
mm,
think uh, Aussie property is cheap, and maybe the way it recovers is that the Australian dollar has to go a lot higher to correct this undervaluation. because
Mm.
gold is a function of gold, but also the Aussie dollar. So
Yeah, yeah, that's true. Okay. I mean, it certainly wouldn't. I wouldn't call properties cheap in Australia. But I think you basically it's undervalued in that sense, essentially, right? So that's the
yeah, yeah,
yeah. So because yeah, like just before we jump on, say if you ask any Sydney-siders, say is Sydney considered cheap? No, Sydney property prices are not considered cheap from a nominal term, but from a relative term, yes, it's undervalued.
correct, correct. Yeah, and that's what we're trying to see through the noise
Yeah.
and arrive at like a sensible, sober judgment of under versus overvaluation because I recognise that it always feels expensive, and in nominal terms, it is. But
Nominal
what's
terms
really
will
happening?
always feel
Yeah,
expensive, right? But unfortunately, our wages are also being paid in nominal terms. That's the problem,
yes,
John.
that's
We're
right.
not being paid in gold. Otherwise, would have
That's right. That's right. No, it's true. Yeah, it's true. No, I think that the gold price and the gold ratio tells us many, many things.
yes,
Um, and maybe the better way to say it is that Sydney prices are undervalued, reflecting an undervalued Australian dollar,
mm,
and that might be a safer way. That maybe the Australian dollar is overcorrected, and it needs to bounce up again, and that's how you'll see that chart normalize a little bit.
rises, yeah. Okay.
Mm.
Great summary, John. Thanks
Cool.
again for preparing this. Next time we're expecting you to get cheap ChatGPT to do it within an hour, isn't it?
Easy peasy, lemon squeezy. Yeah, looking forward to that one. But we'll chat in the meantime.
Yeah, definitely. All right. Well, thanks, John. As always, listeners, none of this is financial advice. Again, please do your own due diligence and talk to specific advisors about what you're trying to do. We will be back again in another episode of Spark Your Fire. Cheers, John and David.